Well, I think that we're certainly modeling out to 2026 and soon shifting into 2027,
Wow.
mainly because when you're looking at those kind of long-term capital expenditure tech growth areas, you have to be looking several years down the road. And while the outperformance differential will be shrinking between tech and the market as a whole, tech still is expected to post very strong results. Just looking at 2026, we're looking at 18% earnings growth versus 13 projected for the S&P 500.
Earnings this period, Sam, how they look to you so far?
Paul, they've looked very good. When we started the period, expectations were only for about a 2% year-on-year rise, according to S&P Capital IQ. And it reminded me of something my father used to say, and that is, rarely do you injure yourself falling out of a basement window. So with the target being set so low, expectations were okay, this will become the 63rd of the last 65 quarters in which the actuals exceed end of quarter estimates. And management, again, has done a wonderful job of managing expectations because the 2.2 is now 8.2. And instead of seven sectors posting declines, now it's only two.
What sectors screen well for you these days, Sam? A lot of folks are concerned that the overall valuation of the S&P 500 is pretty rich at 21 or 22 times. What screens well for you guys?
Well, we are, what I wrote in yesterday's investment policy notes is that while fundamentals tell you what, technicals tell you when and how far.
Okay.
And right now, when we combine the technical reads from our Lowry associates looking at near to intermediate term momentum, but also combining
Right.
our stars recommendations, I come up with groups in the diversified banks, electrical components, gold, investment banking, and system software. So
Right.
you have a good cross read of sectors and sub industries that have attractive valuations, but at the same time have some momentum behind them.
On your commute across the nation, Sam Stovall with us with CFRA. We'll continue a bit more with Sam Stovall, Kathleen Bisjonczyk on deck here with Nationwide on the American economy. Sam, let's get a little nerd here right now. Unit is the amount of time in a given technical chart. Obviously, with your star system, which I was weaned on long ago and far away, that's a much longer unit time that you're looking at. Do you find it efficacious to use daily charts, or as John Maggie preached, weekly charts? Or dare I say, do you go out and use monthly charts?
Use a combination of daily and weekly charts because we're trying to get an idea of what the near term outlook is, but at the same time looking for more of an intermediate term. On April 8th, when the S&P hit the low, what I was looking at is what percent of the 155 sub-industries were trading above both their 50 and 200-day moving averages. That was at 1%, with only healthcare diversifiers plus water utilities in positive mode. That said to me, the investors were throwing the baby out with the bathwater. We also had technical reads in terms of a Zweig thrust. We also had starting with a 90% down day, but then followed up by a Zweig thrust, which said from a shorter term perspective that maybe the bottom has been put in place. So we try to keep our fingers on the pulse of the market. The trend is your friend, and we look for reasons to either stay with the trend
Right.
despite some of the hiccups or to realize that a trend change is at hand.